So we are starting out on this course called Analyzing Financial Statements. And the first chapter has to do with the whole idea of businesses, different business sectors or industries, and the operating cycle. And so what I'd like to do is just share with you, as I said, some of the highlights from the chapter. First of all, this course prefers if you already have taken an accounting class. It's not mandatory, but it is strongly recommended. I know of individuals who take this course simultaneously with a general accounting course from ABA, and it seems to work. But I find that it works best for those who have already completed an accounting course and they are now taking the analysis course. And you can see why, at least from my perspective, because with accounting, what you are doing is putting together or learning how to put together a set of financial statements, whereas with financial statement analysis, you are really breaking apart, pulling apart those financial statements. So to the extent that you know how the financial statements were put together, constructed, I think it will be an easier job for you to pull them apart, all right? If you know how a toy is made, it's going to be easier for you to break that toy apart and possibly put it back together again, as opposed to not knowing how it's done and just taking a sledgehammer and plugging away at the toy. So the same idea applies here as well. So here are, in my opinion, the three key takeaways from chapter 1. There is this thing called the accounting cycle, which is not to be confused with the operating cycle, even though they are related to each other. So what exactly is the accounting cycle? Well, in simple terms, this is what you do in accounting. You start out with recording business transactions, and then you end up with preparing financial statements. That's in essence what the accounting cycle is all about. But there's another cycle, and you'll learn that there are other cycles before this course is over, but these two, the operating cycle is the one that allows you to see how the firm funds its operation. And so it begins with cash, either the firm's own cash or borrowed money, and it ends with cash. And so these two cycles, they relate to each other. What do I mean by that? Well, let's, for example, look at the classification of assets on the balance sheet. If you've done accounting, you know that there are some assets that are classified as current assets, and you know that there are some that are classified as non-current. Well, guess what determines whether an item is classified as current or non-current? It's the operating cycle. The accounting rule says an asset should be classified as a current asset based on two things. One, looking at the operating cycle or the fiscal year, whichever of those two is shorter. And so let's say you are a bank, right? And you have receivables that will take you 3 years to collect. You will classify some of those receivables as current asset because you're now going to be defined by the fiscal year, not by your operating cycle. Because if it takes you 3 years on average to collect on your loans, it means that your operating cycle is at least that long, right? It could be longer. We'll learn how to calculate the actual length of an operating cycle. So these two cycles are related to each other. And we're going to be focusing a lot on the operating cycle. And what you will also be doing, if you have already read the chapter, is notice that we're focusing on 5 or 6 major industries. These are not all the industries. There are at least 19 million businesses in the United States. And so these categories that are emphasized by your textbook, do not capture all 19 million, but these are the major ones that the course will be focusing on. And so what you want to be able to do here is follow the adage, know your customer, right? Because what is the goal of financial statement analysis? Well, based on our context, where we are looking to potentially fund the cash needs of a business, we want to be able to look at the financials and see if the funds are in fact A, needed, and B, whether the firm has the ability to repay the loan. If you were analyzing a firm for the purpose of taking over that business, some of the things you focus on would be similar to what we do in this class, but a lot of it would be different. So understand that what you are learning in this course is actually primarily for commercial lenders, and these are the industries that we are going to be focusing on. If you're looking at my screen, you notice I have to the right of each of these industries a number and or a letter. Well, the number represents the NAICS for that particular industry. So if you wanted to look up the characteristics of agricultural businesses, these are the first two digits of that particular NAICS code. And then the other set is for a similar type of classification called the SIC. I don't know if anyone has ever heard of SIC, which is Standard Industrial Classification. It's similar to the NAICS. However, the way they categorize the industries may be a little different in terms of how the industries are numbered. So you can see one uses only numbers and the other one uses classifications, the letter, and then a number, all right? That's not critical for you at this point, except that if you have a customer and you wanted to look up their NAICS, you could go to the NAICS.com website, type in the company's name or other identifying information such as a phone number or what we call a classification number. You would be able to find that particular business. So let me jump into quickly the accounting cycle. Those of you who have done accounting, and there are a lot of finance majors I saw from the introduction that you provided, you would have known that these are the various aspects of an accounting cycle, right? It starts with transactions that are recorded, and then those transactions are entered in the ledger. We prepare what is called an unadjusted trial balance. Then we make adjustments. We prepare financial statements. Then we will close the books and we prepare what is called a post-close or after the close trial balance, just to test one more time to make sure everything is correct. And then we prepare our financial statements. And of course, we start that process all over again. And this usually happens on an annual basis, right? So that's your accounting cycle. But then you have what is called the operating cycle. And the operating cycle focuses on where your cash comes from and how you use it in order to fund your operation. Now, this is a generic operating cycle, but the basic things are going to stay the same regardless of which industry you are talking about. So for example, if you are agriculture, then you would take your cash and you would buy, I don't know, maybe seeds. You would hire workers to be with you on the farm. You would obtain equipment to be used on the farm. Then you would plant, you would harvest, you would sell, you would collect, but eventually you're going to go through similar processes. So take a look, if you haven't done so yet, at the different operating cycles that are illustrated in your book. And what you will notice that even though the specific things may be a little different, the basic outline is the same, right? So let's say I'm a service business. I would still start with cash, either my own or borrowed funds. And maybe what I will do is I will hire workers and I will purchase supplies as opposed to inventory that a wholesaler or a retailer would purchase. But it's the same basic cycle that we're going to go through. The other thing that we're going to be learning in this class, not in chapter 1, but in a subsequent chapter, is how to calculate the length of that operating cycle. Notice that there are two basic parts to it. There is the holding period, when you will most likely have to borrow funds, and then the collection period, when you would hopefully be able to repay your borrowed funds. So we are going to learn how to calculate the operating cycle. If you've done finance or done second semester or 2 semesters of accounting, you probably already know how to do that. But that is, in essence, what the operating cycle is all about. Like I said, your textbook gives you specific examples for each type of industry. Any questions before I move on to the last couple of slides? Anything regarding the accounting cycle? Anything regarding the operating cycle? Did you read something in the textbook regarding either of these and just didn't make sense? Sometimes silence is golden, but if someone can just tell me that they're fine, then that will be my cue to move on.
It's good.
All right, thank you. Who are you?
This is Rod.
Hi, Rod. All right, so the last major piece of the chapter is looking at these different industries. And what you will notice is that the way the business or the industry operates will dictate what their financial statements look like. Let me warn you though, just not a threat or anything, just a warning. These are general guidelines, okay? These are not hard and fast ratios or percentages. In fact, depending on the source that you use for your industry comparison, it will give you upper and lower and middle quartile, so you can see whether or not your particular client falls into that range. And just because a company is outside of the range doesn't mean that there's a problem necessarily. But what your analysis is supposed to do, at least I learned that eons ago when I started as a credit analyst in the banking industry, is that financial statement analysis is really meant to generate questions. And then you will determine if the answers can be found in the documents that you already have, or if you need to obtain additional information either from your client directly or from some other source. So my recommendation to you is get comfortable with figure 1.14, because that one does a very good job of highlighting, as I have here on the screen, the various industries and the characteristics. You can see that I edited the table a little bit. So I have a column titled Key Financials, but whether you have a heading or not, it's the same thing. So notice that accounts receivable may be present in all of the industries, but depending on the volume of activities that are done on a credit basis versus a cash basis, you can have a low level of receivables or a high level. So does it mean that I should disqualify a potential client because they have a high level of receivables and they're in an industry where it should be low? No. But what it does mean is you need to ask why, right? Why is it that this particular company, which is doing mostly cash, why are they having large receivables? For example, let's say you were looking at a barbershop. You know, they want a loan to buy maybe new chairs for the barbershop. and you saw receivables, that will be unusual, right? Because that's a cash business. And of course, you have issues with, them actually reporting the accurate amount of cash that they received, because of course there are tax implications. But if you saw receivables, it doesn't mean automatically that you disqualify them or you turn the loan down. But what it does mean is, based on your knowledge of the industry, you would want to ask why. And hopefully there will be a legitimate answer, right? So please take your time to go through figure 1.14, because that to me is one of the most important illustrations or diagrams in chapter 1. The other one is the one that shows you the risk profile of the particular industry. And I added this particular item down here because we all have heard of supply chain issues, right? So that's definitely a risk, and it's not just limited to one particular industry. Some will argue, of course, that's an external factor, but the reality is it's a risk, right? That you will have to focus on and find out what it is that the company can do or is doing in order to mitigate that particular risk. In some cases, they may have no control. In other cases, they may have. But the pandemic has shown us that this is, in fact, one of the key risks for businesses, regardless, really, of the industry that you're in. Any questions regarding figure 1.14 and or figure 1.15? I put them here not to go through line by line, because again, you can read, but just to tell you that when you read chapter 1, these are the two illustrations that I would make sure I fully understand, because they capture the key points from chapter 1. I think I'm doing well on time here. So let me ask you to give me your feedback. I have a question. I hope you can see this. All right, and here are the possible answers. Would anyone like to tell me what they believe the correct answer is for this question? Anybody wants to take a shot at it?
Agricultural.
Agricultural. Why do you say that?
They're most likely to have the most equipment associated with their industry that would need maintenance and repair.
Exactly. And so we're not suggesting, right, that other companies would not have issues with that, because trust me, I worked at a university and they had issues with this particular item. But given the nature of the industry, as you said, agriculture, the high percentage, relatively high percentage of fixed assets, I mean, heavy duty equipment that they are going to be needing and using, if they do not care for those things in a timely manner, then that would in fact represent a potential risk that, as a banker, you would want to, a potential lender, I guess, you would want to be aware of. Absolutely correct. All right, one more. That's the question. And here are the possible answers. Do I have anybody else wants to take that one on? It's not too tough, is it? Does the wording of the question make sense? Because, you know, sometimes when I write questions, and I should confess here, I'm the one that writes the assignments. I'm the one that writes your quizzes. I'm the one that writes the exams. And just because I have in my head the concept and I think I'm asking the right question in the right way, doesn't necessarily always follow. So if you come across a question and you're like, what kind of wording is this? Please reach out to me and let me know. So this one, I hope, is properly worded. Anybody wants to try at number 2?
It's D.
It's D, you said, the last one?
Mm-hmm.
Absolutely. Absolutely.